Hello friends, I welcome you to the next lecture. In this lecture we are going to deal with transfer of assets from customers. So when an entity receives an asset, an item of property, plant and equipment from its customers, how should the entity deal with that asset in its books of account is what we are going to discuss in the standard. We are going to talk about Appendix C to Indas 18 and the corresponding international standard is IFRIC 18. So this is what we are going to discuss. I will give you a small background of the standard. Now, you know that certain utility is a company which is involved in water supply, gas supply, electricity supply business. These entities may sometimes receive from its customers an item of property, plant and equipment, or sometimes cash to purchase them. So if you are into water supply business, gas supply business, electricity supply business, these companies can sometimes ask the customer to give them an item of an asset, or they can sometimes ask the customers to pay some cash to buy certain assets. Now why will these companies ask the customers to give them an asset or cash for buying such assets? The company will use these assets to either connect the customer to supply of water, connect the customer to supply of electricity, connect the customer to supply of gas, or they may allow the customer to have access to ongoing supply of goods and services. For these two purposes, either for connecting them to a current network or allowing them to get access to continuous supply of goods and services, the company may sometimes ask the customer to contribute an asset, or company may ask the customer to pay some cash. Okay. So how does the utility, when it receives the item of property, plant equipment from the customer, how do they deal with that asset in their books of account is what we are going to discuss. Okay. Sometimes additional amounts also have to be paid for purchase of goods and services based on the usage. That means just because the customer is connected to my electricity network, just because the customer is connected to my network of gas, I am not going to supply him gas or electricity for free. We are still going to charge him. Sometimes just for getting connection to that network, they have to contribute an asset or they have to give some cash to get them connected to a network. If they are using our gas, water supply, definitely we are going to again charge. Okay. So what we are talking about is an entity is receiving an asset or cash from a customer. With this asset, what we are going to do is we are going to connect the customer to a supply network, or we allow the customer to buy continuous supply of goods and services. Okay. And when they buy goods and services, we are going to charge them some amount. We are not going to give them for free. So how to deal with such situation in the books of the company which is receiving the asset is what we are going to discuss in the standard. Okay. Now, such transfers may all sometimes take place in other industries apart from utilities. In other industries as well, such transactions can take place. There can be a bank which is not capable or competent enough to manage its IT functions. What they may do is they may outsource their IT function completely to a company which is expert in providing these services. Apart from that, what they may do is if they have some current IT equipment, they may also hand over that equipment to the IT company. So now IT company is responsible for providing the services. So bank has given up its assets in favor of the IT company, and IT company has to provide the outsourced services to the bank. So in the books of the IT company, how to deal with that equipment which they have received from the bank is what we are going to discuss. Okay. Sometimes the transferor and the person who is receiving the connection or access to goods services may not be the same. Sometimes what may happen is the guy who is transferring the asset to the entity and the customer who is ultimately going to receive benefits in exchange may not be the same. So you can have third parties as well. So we'll see some examples where you will see that sometimes that the contributor of the asset and the guy who is receiving the benefits because of the contribution may not be the same. Okay. But here we are not doing accounting from the point of view of the customer. We are talking about how to do accounting in the books of the recipient of the asset. Okay. So we are not concerned with who is going to be the beneficiary. We are concerned with in the books of the company which is receiving the item of property, plant equipment, how is he going to account for it in his books of account. Okay. Let's continue. Scope. Now this standard covers agreements where an entity may receive either an item of property, plant and equipment, that is an asset, it can be a machine, it can be an equipment, or it may receive cash from the customer to buy such equipment. In return, what am I going to give? I am going to either connect the customer to a network, or I am going to allow him to get continuous supply of goods and services. Either of the services or both of them. So that means in exchange for the item of equipment, I may connect him, and just with that my responsibility is over. I connect him to a network of gas, electricity, water, and with that my activity is over. Or I can also allow him to continuously buy goods and services with the help of this connection. I'll allow him to get continuous access to services of goods and services, or both. So it can be the first service, second service, or both of them together. Okay. So how to deal with that is what we are going to discuss. Sometimes if entity is receiving an equipment as part of a government grant, then this appendix is not going to apply. If an entity is receiving an equipment and it is covered by Indas 11 service concession agreement, there is a specific prescription on how to do accounting for service concession agreements. If the transaction is covered by that particular appendix which is attached to Indas 11, in such case this standard is not going to apply. So in certain situations where there is a specific standard to deal with the transaction, that specific standard will apply and this general standard is not going to apply. Okay. Now what are the issues? Is the definition of an asset met. So we are talking about accounting issues in the books of the company which is receiving the item of property, plant and equipment. So the first question we have to ask is, before I incorporate the item of equipment in my books of account, there are certain questions to be answered. The first question is, when can I recognize it as an asset in my books? Second is, at what value can I recognize it as an asset in my books? Third is, if I have decided to recognize it as an asset in my books, I know how the standard is going to talk about how to determine the debit. The question is, where will the credit be given? And then ultimately the last question is, if a customer is giving cash to buy an asset, how do you deal with that cash? So these are the four questions which are going to be handled by the standard. Is the definition of an asset met? Second, when can you recognize the asset and at what value can you recognize the asset? Third, where will you give the credit? And fourth, if customer is giving cash to you to buy such assets, how do you deal with that cash? Okay, so these are the issues which are going to be discussed by the standard. Now, is the definition of an asset met? How do you decide whether an asset is met? Whether the definition of an asset is met? See, before you incorporate any item as an asset in your balance sheet, it has to satisfy the definition of an asset which is contained in the framework. As per the framework, the definition of an asset is, it is a resource controlled by an entity. So the most important term there is controlled by an entity. Because of our past activities, it is going to give us, it is probable that future economic benefits will flow to the entity, and you can measure the cost reliably. So when this definition is met, then you can recognize an item as an asset in your books of account. Okay. So the most important point here is control. So you have to establish whether control is there or not. If I have control over the equipment which is contributed to me by the customer, I can recognize it as an asset in my books of account. So how do you determine whether you have control over the asset or not? We have to verify whether these things are there or not. Can I exchange the asset? Can the entity exchange the asset with others? The answer should be yes. Produce goods or services with it. I should be able to produce goods and services using this equipment. I should be able to decide how to maintain it, how to operate it, when to replace it. I should be able to use it to settle my liabilities, or I should be able to distribute it as dividends to my owners, or I should be able to sell it. So when I can do whatever I please with the asset, then definitely I have control over the asset. In such cases, I can recognize the asset in my books of account as an asset. Okay, so the first important question is, you have to decide whether you have control over the asset or not. Now we will see some illustrations where we will see situations where the control definition is not met, and we will also see situations where the control definition is met. Okay. Example, a house builder constructs a house on a redeveloped site in a major city. As part of constructing the house builder installs a pipe from the house to the water main in front of the house. So he is building a pipe from the house to the front of the house to connect it to a water main so that water supply will come to the house. Okay. Because the pipe is on the house's land, the owner of the house can restrict access to the pipe. Because the pipe is in the compound of the house, you can stop others from accessing the pipe. The owner is also responsible for the maintenance of the pipe. That means if there is any repair, if it is damaged, the owner has to take steps for getting it repaired. In this example, the facts indicate that the definition of an asset is not met for the water company, because water company does not have access to the pipe. If any repair has to be done, it has to be done by the owner. The water company cannot do the repairs themselves. So, and the owner has to spend money for getting the pipe repaired, and the water company cannot use this pipe to provide goods and services to others. In such cases, the pipe is in the control of the owner of the house, hence it cannot be considered as an asset of the water supply company. So control definition is not met in this case. The water company cannot show the pipe as an asset in its books of account. Okay. Now we have a similar example, or we can continue the same example, but the facts are changed a little bit. Alternatively, a house builder constructs multiple houses. He is now not constructing one house, but he is constructing multiple houses and installs a pipe now on the commonly owned public land. So he has, we can say, a row of houses which he has constructed, and in front of all these houses there is some public land. In that public land he has installed the pipe. This pipe will be connected with the water main, and this pipe will be used for the purpose of providing water facility to these houses. Now this pipe is installed on the public land, and the ownership of the pipe is given to the water company. If there are any repairs, water company is going to do the repair. If the water company wants, they can use this pipe to provide water connectivity to other households as well who want to get connected to the water supply facility. In such cases, the control definition is met. The pipe can be shown as an asset in the books of account of the water supply company, even though the pipe was laid down by the builder of the houses. Okay. See here again, the builder is the person who is contributing the asset. The person who is receiving the asset is the water supply company, but benefits are ultimately going to be received by the guys who are going to live in those houses, or the owners of those houses who will buy these houses from the builder. So the guy who gave the asset is somebody else. The guy who gave the pipe was the builder, and the people who are receiving the benefits are the people who have purchased these houses from the builder. So the people who have contributed and the people who are ultimately receiving the benefits in return are not one and the same. So they can be also such situation. But we are not talking about how to do accounting in the books of the owners of the houses or in the books of the builder. We are talking about how to do accounting for this pipe in the books of the water supply company. So water supply company has to recognize it as an asset because the control definition is established, because the control definition was met. Now, how should these items be measured initially? So in the last example, the water supply company has received a pipe. At what value can it recognize it in its books of account? The standard says shall be measured at its fair value. So the item of property, plant, equipment should be measured at its fair value. Such fair value would be treated as cost for initial recognition. So that fair value will become cost for the company which has received the asset. If asset is transferred, its fair value will become cost. If cash is paid, cost incurred to construct the asset would be considered as fair value. So if suppose the customer is paying cash to the entity, whatever cost the entity has incurred to construct the asset, that will be considered as the fair value of the asset. Okay. Now, how should the credit be accounted for? See, we have discussed two questions till now. When can I recognize an asset? At what value can I recognize an asset? At what value can I recognize the asset? The answer was at fair value of the asset which was received. Now, question comes, I have debited asset account, so where should I give the credit? Now, we are going to discuss that. So, based on Indas 18, the agreement is for exchange of dissimilar goods and services, hence revenue needs to be recognized. That means credit would be given to revenue immediately or deferred based on the circumstances. See, as per Indas 18, if you are exchanging similar goods and services, no revenue can be recognized. That means you have given some services and received some services in return. Both are similar. You have given up some goods and you have received the same goods. In such cases, no revenue should be recognized. But when the goods and services which are exchanged are dissimilar in nature, definitely revenue has to be recognized as per Indas 18. Now, how can you measure the revenue? It should be based on fair value of the consideration received. So, you have given some services, you have provided some goods. So, you have to recognize revenue relating to it. At what value? At fair value of the consideration received or receivable. So, as per Indas 18, when there is exchange of similar goods, no revenue can be recognized. When there is an exchange of dissimilar goods, revenue has to be recognized. Okay, that means, now see here, this Indas 18 prescription will apply because the entity is receiving an asset, an item of property, plant, equipment. In exchange, it is providing customer connection, or it is providing customer access to ongoing supply of goods and services, or both of them. So what I have received is an equipment. What am I giving in return? Connection or ongoing access to supply of goods and services, or sometimes both. So that means what I have exchanged are not similar. That is why we have to recognize some revenue. Okay, that means when I receive an item of property, plant, equipment, I should give credit to revenue. Revenue can be recognized immediately or sometimes deferred. When can we recognize revenue immediately, and when we should recognize the revenue on a deferred basis is what we are going to discuss later. Okay. Now, identifying separately identifiable services. See, we all know that, by now you would have understood that when an entity receives an item of property, plant, equipment, in exchange it has to provide customers two services, or both of them, or either of them. What are they? One, provide customer with connectivity to the network, connectivity to water supply, electricity supply, gas supply. Just provide connectivity to the customer, that's it. Or provide him access to ongoing supply of goods and services, or sometimes both. So the agreement here has two components in it. One, providing connectivity to the customer to the network, sometimes providing customer ongoing access to supply of goods and services, sometimes both. That means you have to provide both connectivity and ongoing access. So we have to divide the agreement into parts, and we have to try to find out how much is the revenue relating to provide connectivity and how much is the revenue relating to providing ongoing access to supply of goods and services. I'll again simplify it. I'm receiving an item of property, plant and equipment. In return, one service is I can provide connectivity to the customer, or I'll provide ongoing access to supply of goods and services. That means continuously I'll supply goods and services, or sometimes both. So the revenue has to be split, has to be divided between these two components of the agreement, and then we have to recognize revenue independently for each component based on recognition criteria. Okay, so let us go ahead and learn about it. Connecting customer to a network separately identifiable service. See, I told you, in exchange for the asset, I can provide two services, both of them or sometimes both of them, either or both. First is providing connectivity to the customer. Sometimes this itself can be a service which I am providing in exchange for property, plant and equipment, or it can be providing customer ongoing supply, access to ongoing supply of goods and services. That means continuously I'll keep supplying goods and services, or sometimes both. Okay. So now let us take the first component. Connecting customer to a network separately identifiable service. That means when can connecting a customer to a network can be identified as a separate service. Connection is delivered and represents standalone value to the customer. Fair value of the connection can be measured reliably. Customer feels just getting connectivity has standalone value to him, and the value of the connection can be estimated. Fair value of the connection can be estimated. In such cases, we can say that in exchange for the equipment, one of the service I have provided is providing connectivity to the customer. Now, an example you can see here. Fair value of a residential property which is connected to gas, water or electricity network is more than unconnected property. So when you do some research, you find out that there is a property which is connected to gas, electricity and water supply, and there is a property which is not connected to any of these networks. In such cases, you will definitely find that the property which is connected to all of them, the fair value would be higher than the fair value of the property which is not connected to any one of them. That means this connectivity itself has some value. Customers, people who are ready to buy properties, they will be ready to pay more if the property is already connected to supply of gas, air and electricity. If they are not connected, they will be ready to pay less because they know that they have to spend some money to get that connectivity. Is it clear? So in certain situations, just providing connectivity to the customer would be one service which I am providing in exchange for the property, plant and equipment which has been contributed by the customer. We will see an example on it. Now, a real estate company is building residential properties in an area not connected to electricity network. That means in a very far off area we are constructing residential properties, the builder. Okay. It has to either construct a substation according to the specification of the network company or pay cash to get it constructed by the network company. So to get electricity supplied to these properties, the builder has to either build a substation according to the specifications of a network company. The business of the network company is to provide electricity connection and provide electricity. So the builder has to either build a substation according to the specification of the network company, that is the electrical supply network company, or pay cash to the electricity network company, so that with that cash they can build a substation, and with that substation they will provide electricity connectivity to the people who have purchased those properties. Okay. The network company will use the substation to connect properties to the electricity supply network. Replacement, repair, operation will be done by the network company. That means you are giving control of the substation to the network company. Okay. The owners of the property can get the electricity at a price decided by the regulator. That means if you are residing in these properties, you are getting connectivity from the network company and you are buying power. The rate at which you will buy power will be on par with somebody who has not contributed any substation. Okay. So the owners of the property can get the electricity at the price decided by the regulator, which is on par with the price charged to somebody who has not paid for the construction of the substation. That means there is no price differential. You are not getting any discounts because you have contributed a substation. You are going to get the price still at the same price. So if somebody has contributed a substation and somebody who has not contributed a substation, they both are going to get the power at the same price because the power is the rate is regulated by a regulator. That means I am not getting any extra benefit just because I have contributed a substation. The owners can either choose to purchase electricity from either the network company or the others. That means we can even select our provider of electricity. I have to get connectivity with the help of the network company. I may choose to buy power from the network company, or I can choose to buy power from somebody else also. The other company can also supply electricity to me through the same network. Okay. Conclusion. The only service to be provided is to connect the customers to the network. So in exchange for the substation, what is the network company doing? It is only providing connectivity to the customer. Okay. Hence, the fair value of the substation can be recognized as revenue on completion of connecting activity. So, as soon as the network company is connecting the customers to the electricity network, they can recognize the fair value of substation in their books of accounts as revenue. That means the electricity network company can pass an entry substation account letter to revenue account as soon as they connect the customers to the electricity network. Okay, because that is the only obligation which they have in exchange for the item of property and equipment which they have received from the customer. Okay. So in this example, we are providing customer with only one service, that is connecting him to an electricity network. We are not providing him any other service. We are not providing him electricity at a cheaper price. We are not giving him any discounts. If the customer wants, he can buy electricity from me, or he can buy electricity from somebody else as well. That means the only service I am providing in exchange for property plant equipment is getting him connected to a network. Hence, as soon as I connect the customer to a network, I can recognize it as revenue in my books of account. What can I recognize as revenue? The fair value of the substation I can recognize as revenue in my books of account. Okay. Now, sometimes providing access to ongoing supply of goods and services identifiable as a component. So, I have received an item of property plant equipment. Sometimes in return, I have to allow the customer to get access to ongoing supply of goods and services. In such cases, the value of the equipment which you have received from the customer in exchange for ongoing supply of goods and services, the fair value of the equipment has to be recognized as revenue over the agreement period. Okay, so let us see. Price charged for goods and services is lower than would be charged without transfer of item of property plant equipment. It becomes a separate component. Conversely, if the same price is charged irrespective of the transfer, it cannot be identifiable as a separate component. I will give a simple example. A customer contributes an item of property plant equipment to me. I provide him gas in return, but the price which I charge to him is lower than the price which I charge to a customer who has not contributed an asset to me. In such cases, I am allowing this customer an ongoing access to the goods or service which I am providing, that is supply of gas, at a discounted price. In such cases, the equipment which I have received from the customer as a contribution has to be recognized as revenue over the period in which the customer is going to receive benefits from me in exchange. Okay. But suppose if I am providing the access to the customer at the same price, somebody who has not contributed an equipment and somebody who has contributed an equipment, the price charged for the goods and services is the same. That means the equipment, in return for the equipment, I am not providing him any additional benefit. The only benefit I am providing him is providing connectivity. In such case, as soon as I provide connectivity, I can recognize revenue. If I am going to provide him goods and services at a lower price, then in such cases, I have to recognize the fair value of this equipment over the agreement period as revenue. Okay. Now, example, a bank outsources its IT function and also transfers ownership of its IT equipment. Remaining life of the equipment is 3 years. Okay. So the IT equipment remaining life is 3 years to an IT company. The IT company has to, so I hope you are able to understand, a bank outsources its IT function and also transfers ownership of its IT equipment. Remaining life of that equipment is 3 years to an IT company. The IT company has to provide IT services for a period of 10 years, that means service for a period of 10 years, for fee which is lower than what would have been charged if there was no transfer of equipment. That means the fees which has been decided between the bank and the IT company is lower than what would have been the fees if the equipment was not handed over by the bank to the IT company. The revenue from exchange transaction has to be recognized over a 10-year period. So whatever is the revenue from this transaction, it has to be recognized over a 10-year period. So how will it be recognized? For first 3 years, fair value of the equipment divided by 3 plus some reduced fees. For the next 7 years, revenue would be increased fee income. We are going to charge more because I have to now replace, because first 3 years I can use the old equipment. Hence the fees will be low, but the fair value of the equipment which was received will also be recognized as revenue. But in the next 7 years I am going to charge more fees because I have to now replace the old equipment with new equipment. Automatically fees will increase. So the next 7 years, increase in fees income, increase represents cost of replacing the old equipment, because the equipment will come to the end of its useful life after 3 years. Next 7 years I have to replace the old equipment and provide service with the new equipment. Automatically cost will be more, that means charge will also be more. Okay. So we'll see an example to apply this particular situation. Example, 1000 lakhs for 10 years without equipment. The agreement was 1000 lakhs for 10 years without equipment. With equipment only 900 lakhs. That means the fair value of the equipment which is, we can say, given up by the bank to the IT company is 100 lakh. Without equipment was 1000 lakh. With equipment it is 900 lakh. That means this difference is only because of equipment. That means the fair value of the equipment is 100 lakh. So that means fair value of the equipment is 100 lakh. For the first 3 years, how am I going to recognize revenue? See, for the first 3 years, the total revenue from the agreement is 1000. It is for 10-year period. That means for 3 years it should be 1000 divided by 10 into 3. It should be 300. That means first 3 years you can totally recognize a revenue of only 300 lakh. Out of this 300 lakh, 100 lakh is fair value of the equipment which is received from the bank. Remaining 200 lakh is the fees income. So 1000 lakh divided by 10 into 3. 300 lakh is the total revenue for the first 3 years. This 1000 lakh has come, 900 lakh in the form of cash and 100 lakh in the form of equipment. So 1000 divided by 10 into 3. 300 lakh is the total revenue for the 3-year period. Out of this 300 lakh, 100 lakh is the fair value of the equipment and remaining 200 lakh is the amount of fees which I am going to charge in cash. So how am I going to recognize it as income? So first 3 years, 100 by 3, 33.33 is the deferred revenue which I am going to recognize in my books. So entry I'll pass is equipment account dot deferred revenue account dot to revenue, deferred revenue to revenue, deferred revenue to revenue every year 33.33. That means over 3-year period the entire 100 would be recognized as income. And reduced fees would be 200 by 300, 66.67. How did I get this 200? 300 was the total revenue for the 3-year period, 100 is the fair value of the equipment, remaining 200 is the fees to be charged. 200 divided by 3, 66.67 would be charged as fees income. And per annum would be again be 100, 33.33 plus 66.67 is again 100. For the last 7 years it will be same, straightforward. 1000 divided by 10 into 7, 700 will be the amount of revenue recognized in the 7 years. So if you want to reconcile, you can reconcile 700 plus 200 is 900. That is what is going to be paid in cash. Fair value of the equipment which was taken from the bank, 100. So we are going to totally recognize the revenue of 1000. So this is how I am going to deal with this. In this situation, see, we said in exchange for plant and equipment there can be 2 pieces of services I can provide: connecting the customer to a network or providing ongoing supply of services. See, in this particular case there is no question of providing connectivity to any customer. So the only component left is providing customer with ongoing supply of goods and services. Hence the entire fair value of the consideration received was recognized over the agreement period. Okay, fair value of the equipment was recognized only over its remaining useful life, but the remaining revenue was recognized over the agreement period. Okay. Now revenue recognition, when only connection has to be provided. So in exchange for property, plant and equipment I have to provide only connection. That's it. That means as soon as you provide connection you can recognize revenue. Second, when I have to only provide ongoing access to supply of goods and services, that means I have to only provide continuous supply of goods and services to customer. That's it. I don't have any liability to connect him to a network. In such cases, over the agreement period you can recognize the fair value of the property, plant and equipment as revenue. If the life of the property, plant and equipment is lower than the agreement period, then over its useful life you have to recognize it as income. If you have to provide both, then the fair value of the item of property, plant and equipment which has been received has to be allocated to the component relating to provide connectivity and component relating to provide ongoing supply of access to ongoing supply of goods and services. In exchange for asset, if you have to provide both the services, connectivity and ongoing access, in such cases the fair value of the asset has to be allocated to these items and recognize revenue based on the relevant rules. Okay. Now we have a comprehensive example in front of us. Builder Limited is constructing a residential complex with 10 units. That means there are 10 residential units in this complex. It has to connect these units with a telecommunication network and also provide telecommunication facilities. It enters into an agreement with the Digital, a telecommunications company, for this purpose. Digital would have exclusive rights to provide services in the complex for 10 years. So the agreement provides that Digital will provide exclusive services for 10 years. That means for these 10 years nobody else can provide the services to this complex. Monthly charge would be 1000 instead of 1200. So Digital is ready to provide the services at a discounted price, that is 1000 rupees instead of 1200. But it does not represent. So this difference is not quantity discount. Then why is Digital giving a quantity discount? We will come to know in the next slide. So to complete the agreement, Builder Limited has to either provide a special telephone substation according to specification of Digital, or it has to pay for the cost of construction to Digital. That means the Digital company says you have to either provide me a specifically made telecommunication substation, or you have to give me cash to build that substation. Only with the help of the substation I can connect your customers, I can connect the properties to telecommunication network and provide them telecommunication services. So what does the builder do? Builder Limited decides to provide for it. Provide for it means he has decided to build the telecommunication substation on his own according to specification of digital, and then he will hand over the substation to digital. With the help of this substation, the company digital is going to provide connectivity to the people who are living in these properties, and they are going to charge them monthly fees also for the ongoing services which they are going to provide. Fair value of the substation is rupees 6 lakh. Life is 15 years. So life of the equipment is 15 years. Fair value of the equipment is 6 lakh. Okay. So the builder is now contributing an asset to digital which has a fair value of 6 lakh. Now digital has two liabilities in exchange for this asset. One, it has to connect the customers to telecommunication network. Second, it has to provide ongoing supply of services also. Okay, so it has to we can say fulfill both the obligations. So now let us see the fair accounting. Fair value of the equipment is 6 lakh. Value of benefit in the form of reduced prices. 200 rupees is the saving per month, 12 months. 2400 is the saving per unit. 10 units, 24,000 rupees. 10 years, 2,40,000 rupees. So this is the total benefit which I am providing to the customer in exchange for the equipment, and this benefit is given over the period of usage of the services, over a period of 10 years to all these 10 customers. Value of the connection is now remaining value. 6 lakh minus 2,40,000, 3,60,000. So what I am doing is, I have received an item of property, plant and equipment. I want to find out of the fair value of the equipment received, how much can be allocated to the component, the part of the agreement which deals with providing ongoing supply of goods and services. I am providing the people who are residing in these units connectivity to my network at a discounted price. They are saving at least 200 rupees per month, 2000 rupees, 400 rupees per annum. For one unit, 24,000 rupees for all the unit holders, and 2,40,000 over 10-year period. So out of the 6 lakh rupees, 2,40,000 is attributable to ongoing access of goods and services. The remaining 3,60,000 is relating to providing connectivity to the customers to my network. So entries would be property, plant and equipment account that are to deferred revenue 6 lakh. Depreciation of asset over its useful life. The telecommunication substation has to be depreciated over the useful life. So every year we are going to provide 40,000 as depreciation. I am assuming residual value as 0, useful life as 15 years, 6 lakh by 15, 40,000 will be the annual depreciation. Revenue from services. I have to recognize a portion of the deferred revenue as revenue from services and revenue from providing connectivity. So how much revenue can I recognize towards services? Total 2,40,000 was the total saving for the customers by accessing ongoing supply of goods and services. Per annum it was 24,000. So I will pass into deferred revenue account to revenue 24,000. And then revenue from connectivity. As soon as I connect the customers to the telecommunication network, I can pass this entry, deferred revenue account to revenue account 3,60,000 rupees. So 2,40,000 will be deferred and recognized over the period in which I provide access to the supply of goods and services, which is 10 years. So 2,40,000 divided by 10, 24,000 every year will be recognized. Connectivity, as soon as I connect, my responsibility is over. I can recognize 2,60,000 as income in my books of account. So what we can say here is, I am receiving property, plant and equipment for providing connectivity. As soon as I complete connectivity, I can recognize the 60 as income. Second, I have also received property, plant and equipment like a prepayment. So the customers are like prepaying their telephone bills to me in the form of property, plant and equipment. Just because I have received the prepayment, I cannot recognize it as revenue now. I have to defer it and recognize it over the period in which I am providing services. Okay. So this was a requirement of the appendix which we have discussed in this particular presentation. Thanks a lot.